What's up, guys? Nick here, and today I'm going to be talking about why the market is in for a tumultuous next few months and what I am planning to do about it. Now, as usual, I'm not a licensed financial professional. I'm just a guy sitting in his caddy talking about finance and the stock market. But I do think it's fairly interesting what we're seeing right now, so I wanted to make a video touching on the events we've seen really in the last week. The market has pulled back significantly, which it sounds like a serious crash, but in reality, most stocks have only lost their gains from the past month or two. So yes, it has been a substantial pullback, but it hasn't actually been a bottom out crash yet. And there are things in our system and in the environment of investing that are different compared to even the last major financial crash, which was 2008, that might keep us from bottoming out like we did. But in my opinion, based on the research I've done, the historical conditions are rather bearish for the market for 2021. And here's why. So going back last year, we had the COVID crash, which was much larger than the crash we saw last week. The stock market correlates with the news. The stock market hates uncertainty. For all you new investors out there, anytime there's any rumor of a war or a major natural disaster or job losses, it is bad for the stock market. The stock market usually goes down on news like that. So obviously, when all non-essential businesses get rather suddenly shut down in the United States, it tanked the market. And because of that condition, you had a good portion of the U.S. workforce that was sitting at home unemployed. And then you had the other portion of the U.S. population that was no longer going out and spending their extra money on recreational things. That you weren't going to bars and restaurants, you're not going to movie theaters, you're not going to watch your favorite sports team play in person, you are stuck at home. So you add on to that the United States passed the CARES Act, which was a $1,200 stimulus check that went to most Americans making under, I think it was like $100,000 originally a year. And you had extra unemployment benefits. Not only did you have extensions in insurance coverages and so on, but each state had their own added on bonus to unemployment. For example, my state of Ohio, unemployment was giving $600 extra a week on top of what your regular compensation would be. So you have a condition where people are uncertain about the future of their job. However, they are at home saving more money because they are not going out and doing recreational things, but also in a lot of cases making more money due to stimulus and extra unemployment. And you also have an opportunity where the stock market is particularly low. And it was red across the board. I mean, from Amazon to Apple to Tesla to Facebook to Microsoft, Twitter, all the heavy hitters. I mean, airlines and entertainment stocks still haven't fully recovered from the shutdown. All of them were red across the board. So that gave new investors the time to learn about how to invest their money and a good entry point on blue chip stocks. And that is why the stock market, despite the record unemployment, despite a pandemic that was killing hundreds and thousands of people over the course of weeks and months, despite a good portion of businesses in America being shut down and maybe not ever reopening in some instances, the stock market was seeing record gains and getting to all-time highs. You had a large influx of new investors with more money than they normally would have, more money than they normally make, all getting into the market at the same time. Now you fast forward just about a year later, and what do we have? Well, there are the Johnson & Johnson vaccine, the Novavax vaccine, the Pfizer vaccine are all being distributed and have pretty well hit those older demographics that are usually most vulnerable to the illness, and are now starting to get out to healthcare workers, essential workers, and the more younger demographics. So we are well on course to being back to, quote, normal. But for the market, there's going to be a few things we're going to see. The first thing we're going to see is that people are going to go back to work, or they're going to get new jobs. Unemployment is going to run out. There likely, very, very likely will not be any stimulus checks after this next one, if we even get the full 1,400. But you're talking about a situation where people are back at work and not making as much money, and all of their old habits are back. All of the things they used to do recreationally, now in Ohio, the bars are open till 2 a.m. again. Movie theaters are opening back up. Sports venues are gradually allowing more participants, more people to come to the games. So now they are making less money, and they're spending more of their disposable income on recreational things, which means they're investing less, which means you're not going to see the record-breaking gains in the stock market in 2021 that we saw in 2020. Now, this sort of spooks a lot of new investors, because when they see their Tesla going up, $2 to $5 a day instead of $20 a day, they think that the stock has peaked out, and they start selling off. And what happens when they sell off is the stock exponentially gets less expensive, gets cheaper, and therefore brings the stock down, which causes other stocks to go down, which brings the market down. And a lot of these newer investors, they really did get in on a good opportunity, but they didn't actually understand the full fundamentals of investing from a more long-term perspective. There were people that overinvested their unemployments and their stimulus, and then when tax season came back, they had to pay tax on that, and they had to sell some of their stocks. Or there was instances where people realized that they couldn't keep investing at the rate they were investing in 2020, so now they've had to cut that back. Or they're satisfied with their gains and they're not making the money they were making, and now all their favorite places are open again, so they're selling some stocks to boost their quality of life again. And you'll hear people say, well, this is why it's good to invest in cryptocurrency, because it's a leverage against stuff like this. And that's not entirely true, because most investors treat cryptocurrency as more of an asset or an investment than an actual currency. So that's why we've been seeing the Bitcoin and Ethereum also fall with the rest of the stock market. So really what this tells us here is that it's likely not going to be the same gains we saw in 2020. So as an investor, what do you do? Well, now you learn which stocks you would like for a long-term hold rather than your quick cash outs. And this requires you as an investor to do more research on the companies that you invest in, not only from a financial perspective, but what's their business plan, what sort of new innovations do they have, what kind of leadership do they have. Also, this is when you sort of make a more budgeted investing plan and learn to invest in more than just the stock market. You could use some of your gains from the stock market to maybe add on to your home, get into some real estate, or do some stuff with your vehicle, or even like a hobby you have that you can make into a business. So I don't believe that, and there's other factors as to why the market went down. There's fears of hiring interest rates. There's fears that, there's a lot of outstanding margin and debt among investors. But I ultimately believe, and it's historically true, that when the stock market crashes, it does eventually recover. Sometimes it takes longer, though, which is why it's not always necessarily responsible to go all in on a dip, because sometimes a dip can go even lower and not go back up for years. For example, Microsoft during the dot-com bubble, which was in 2000, only regained the value they had in 2000 back just last year in 2020. The shares of Microsoft fell from like in the $150 range to $50 in 2000 during the dot-com bubble. And it's ironic because, as history would say, preluding to the Great Depression, there was a lot of overconfidence in the market. A lot of people were excited about General Motors and Radio Shack, these new tech and automotive companies. Going back to 2000, it was the internet. Anything with the internet in it, people wanted to invest in, notably Microsoft. 2008, there was a lot of overconfidence in real estate. People were buying real estate they ultimately couldn't afford. So now you go to 2020, and what have we seen? Well, there's big confidence in electric vehicles. There's big confidence in EVs. There's still big confidence in tech. And what I believe we've seen in the last week or so is investors realizing that perhaps they got ahead of themselves in their confidence. Now, I personally don't believe we'll see like a traumatic crash, because I believe that with the amount of retail investors we have, with the provisions the government has in place, we won't, crashes don't hurt the economy as bad as they used to. But it is a tumultuous time, and in my personal play, I am holding what I have and gathering cash to continue to add on the red days. But I'm also not going to be greedy, because I expect more red days to come in the coming weeks and even months, because I believe new investors maybe got in over their head. They invested more than they were actually making or actually had. I believe that people are returning to a more normal lifestyle, so they're going to use their disposable income on recreational things instead of investing. And I believe that we will, with all the stimulus and unemployment, we are going to see a little bit of inflation, and we're going to see, obviously, gas prices are up quite a bit. Obviously, grocery prices going up a little bit. So it's just really, investing is a good thing to do, but you want to remember what Warren Buffett said. Be fearful when people are greedy, and be greedy when people are fearful. And you don't want to, the worst thing you can do, and it's ironic to say about an endeavor that is solely to make you more money, the worst thing you could do is get overly greedy, because that in turn is how you lose. You want to stick to a fundamental, you want to stick to a system, and this applies for buying and selling too. So let's say you're eyeing down like Apple. Well, you don't want to just buy Apple no matter what. You want to set price targets. So it's like, okay, if Apple falls below $118, I'm going to add on to my position. Or vice versa. I mean, Apple's sort of a hold. I don't think you really want to sell them too often. But if you have a stock like a Zoom or a Peloton, something that was a heavy benefiter of the pandemic, you might say, well, if the price goes up of Peloton to 130, I'm going to sell out of some of my position or close my position. So those are things you want to keep in mind as an investor. It's not a reason to stop investing, but right now I believe this is an opportunity to take these days, learn from them, and become a better investor. As always, Thank you much for watching. Like and subscribe. Hit me with some feedback. I'm going to be posting more often. It's been sort of a busy, little allergies going on, but no Rona, thankfully. So thank you guys much. This is Nick. I'm out. Peace.